A brief history of money and finance. 1. Introduction. Money and finance are central to modern life, yet for most of human history people lived with little need for money. Before the Industrial Revolution, households were largely self-sufficient, relying on agriculture, livestock, and inherited land. As towns expanded and specialization increased, money emerged as a convenient medium of exchange, unit of account, and store value. Over time, money evolved from commodities such as grain and metals into coins, paper currency, bank deposits, and finally electronic and contractual forms of payment. This report provides a non-technical historical overview of the development of money, finance, and financial institutions, tracing their evolution from ancient civilizations to modern securitization and financial crises. 2. Early monetary systems. 2.1 Barter and commodity money. Early societies relied on barter, exchanging goods directly. However, barter was inefficient due to the double coincidence of wants. To overcome this, societies adopted commodity money, items with intrinsic value such as cattle, grain, shells, copper, silver, and gold. 2.2 The Sumerians in Mesopotamia, circa 3000 BC. The Sumerians developed one of the earliest known monetary and financial systems. Grain served as the primary unit of account in rural areas, while silver was used in urban trade. Money was not yet coined, but weighed. Financial transactions were regulated under the Code of Hammurabi, circa 1800 BC, which defined property rights and credit contracts, set maximum interest rates, 33.33% for grain loans, 20% for silver loans, allowed debt pledges but limited debt slavery to 3 years, protected farmers by linking repayment to harvest outcomes. Temples functioned as early banks, providing interest-free or low-interest loans, especially to the poor. 3. Money and finance in biblical times. Biblical texts reveal strong ethical concerns regarding finance. Laws aim to prevent excessive inequality and exploitation. The Jubilee year, every 50 years, restored land to original families. Interest-free loans were encouraged for the poor. Humane treatment of debtors was mandated. Money also played a role in marriage contracts through dowries, reflecting its growing social importance. 4. Classical Antiquity. 4.1 Greece. Coin money emerged in Lydia in the 7th century BC and spread throughout Greece. Coins standardized value and greatly facilitated trade. Greek finance included personal and commercial loans, loans secured on land, municipal borrowing, endowments, and speculative trade loans. Interest rates could be extremely high, especially for unsecured or risky loans. The Greeks also developed early derivatives, such as option-like contracts, as illustrated by Aristotle's account of Thales and olive presses. 4.2 Rome. The Romans expanded financial institutions further, developing banking houses, argentarii, public debt markets, sophisticated legal frameworks for contracts. Roman finance supported a vast empire, but was vulnerable to political instability and debasement of coinage. 5. Medieval finance. 5.1 Fairs, exchange, and bills of exchange. Medieval trade fairs in Genoa, Lyon, and Champagne required mechanisms to handle multiple currencies. Merchant bankers collectively set exchange rates. Bills of exchange emerged as a revolutionary financial innovation, allowing long-distance payments without transporting precious metals. Short-term credit. Hidden interest through exchange rate adjustments, bypassing usury laws. 5.2 Jewish merchant networks. Jewish communities, connected by family and religious ties, played a major role in European trade and finance, contributing to the emergence of financial centers, such as Antwerp, Amsterdam, and later London. 6. The rise of stock exchanges. 6.1 Antwerp. The Antwerp Exchange, 1460, was the first organized commodities exchange. It fostered speculation, futures trading, and standardized contracts, laying the groundwork for modern exchanges. 6.2 Amsterdam. In 1602, the Dutch East India Company, VOC, became the world's first publicly traded company. Its shares were traded on the Amsterdam Stock Exchange, the first true stock exchange. The VOC operated global trade routes, paid high and irregular dividends, encouraged secondary market trading, speculation, and early options. Amsterdam became the financial capital of the 17th century. 6.3 London and New York. London's Royal Exchange 1570 and later coffeehouse trading expanded securities markets. Wall Street originated from informal trading under a buttonwood tree, leading to the New York Stock Exchange in 1792. 7. Speculation and financial bubbles. 7.1 Tulip Mania, 1630s. Tulip mania in the Netherlands is often cited as the first recorded speculative bubble. Tulip futures and option-like contracts allowed massive leverage. Key features: prices far exceeded fundamental values. Contracts were transformed into options by legal decree. Collapse caused widespread losses and economic disruption. Tulip mania highlighted the dangers of leverage, speculation, and weak regulation. 8. Early derivatives in the United States. In the 19th century, over-the-counter trading in puts and calls developed in the U.S. These markets lacked standardization, were prone to manipulation by pools and insiders, often exploited uninformed investors. Following the 1929 Wall Street crash, the Securities and Exchange Commission (SEC) was established. While initially considering banning options, regulators eventually recognized their legitimate uses for hedging and risk management. 9. Securitization and modern finance. 9.1 What is securitization? Securitization is the process of pooling financial assets, such as mortgages or loans, and converting them into tradable securities sold to investors. 9.2 Historical development. Early mortgage pooling began in the U.S. in the 1930s. Government-sponsored entities expanded mortgage-backed securities, MBS. By the late 20th century, securitization extended to auto loans, credit cards, and corporate debt. 9.3 Benefits. Increased liquidity, risk distribution, lower borrowing costs. 9.4 Risks. Complexity and opacity, misaligned incentives, excessive leverage. 10. The global financial crisis of 2008. The 2008 crisis was rooted in subprime mortgage lending, excessive securitization and derivatives, CDOs, CDS, weak regulation, and flawed risk models. When U.S. housing prices fell, mortgage defaults surged, securitized assets collapsed in value, global banking systems faced insolvency, governments intervened through bailouts, stimulus packages, and regulatory reforms. 11. Conclusion. The history of money and finance is a story of innovation driven by trade, growth, and risk management. From grain loans in ancient Mesopotamia to complex securitized products in modern markets, financial systems have repeatedly balanced efficiency against instability. Understanding this history is essential for designing more resilient and equitable financial systems in the future.